John, you know, what's your take on these comments? And, you know, if you look at that jobs report last week, you'll go, recession? What recession? I mean, the job market is holding up. We've got inflation high, but perhaps have we seen peak inflation? But give us your overall macro take.
Well, it is likely to be the most unusual recession that we've experienced in...
A recession with full employment, I mean...
Well, exactly. Potentially with decades. It's very hard to see those unemployment numbers rising unless interest rates are hiked substantially higher than perhaps the market's pricing in right now. Possibly that's why we get Fed governors hinting occasionally that we should be looking beyond that expected 5% terminal rate, maybe for something closer to 6-7%, as Bullard was promoting in his worst case outlook. But, you know, in general, I think we're probably tilting towards something of a soft landing. Whether that is actually a technical recession is less important. But I foresee a slowing clearly in growth in the United States next year. I don't see a hard landing. I think that equates to something like 5 to 10% contraction in EPS growth. For the S&P, that's my sort of target for the equity markets. And of course, the flip side to that is a policy error, some kind of risk that we haven't necessarily anticipated, which tips the US economy into a substantially harder landing, and clearly that will have global impacts around the economy.
So, underweight equities, I guess, is what you're trying to say, is as far as market goes.
Completely underweight equities. I think that we're still likely to experience some revisions to earnings growth, some downward revisions to earnings growth in the months and quarters ahead. I don't think that's been accurately priced in yet. I have seen an improvement in valuation metrics. You know, we started this year with the price earnings for the S&P around 24 times. I think it's come off down to about 16, 17 times now, which is consistent with the decline in prices. But overall, I think markets are likely to trade sideways, actually. I foresee in a slow growth environment that we're forecasting 0.8% for the US over the course of next year. It's hard to get really excited about S&P taking off in any meaningful way, unless, of course, we get this sense that maybe the economy is even softer than anticipated. But listening to your talking heads relating to growth risks, that doesn't seem to be the base case there.
And what questions are you getting, just to pivot to the Chinese markets, what questions are you getting from clients in China?
Well, the main question...
Has the narrative changed?
Certainly the narrative has changed. Whether the reality has changed is another thing. The narrative, particularly crafted by foreign investors, is that we can now look through COVID. Some 50% of China's economy right now is impacted by cities which contribute to overall growth levels. Foreign investors are looking through that. They're now looking to reopening. They're looking at sunlit uplands into the second half of next year. What we're seeing on the ground is nothing like that. We're seeing still quite restricted, constrained operating conditions, growth outlook which looks really quite challenging, and nothing really yet to justify this 35% bounce that we've seen, for example, in the MSCI China index over the last 4 to 6 weeks. So I'm cautious about the level of optimism that's priced in. I note also that it's coincident and commensurate with a decline in the dollar index over precisely that same index. And of course, a weaker dollar tends to be high-octane optimism for Asian equities. My sense is, though, that we'll see something of that this is something of a corrective rally, and it'll probably diminish into December, January.
My question then would be, if we are looking at, and just tying in the softer outlook for the U.S. next year, and if that means still a weak dollar, might that be enough for risk assets, at least in emerging markets, to find some sort of floor?
Certainly a weak dollar tends to be quite supportive from a liquidity perspective. We see investors actually unwinding their holdings in dollars and seeking growth and opportunity, growth and earnings, particularly in Asian equities. My sense is, though, if we start to see a deceleration in growth and demand in the United States, it will likely feed through to poorer corporate earnings in Asia. That tends to be the relationship that plays through. And so for me, the story is really one about growth. It's about interest rates. It's about dollar. And then we extrapolate the trends and the interpolations from that to the Asian markets.